Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Thank you for joining us today on the Going Long podcast. Today, our guest is Thomas Burberl, the CEO and Director of AXA, one of the world's largest insurance companies. He started his career at the Boston Consulting Group and then worked for the Winterthur Group and Zurich Insurance Group, where he was CEO for Switzerland. In 2012, he joined AXA as CEO of AXA Germany, and prior to his current role, he was CEO of the global business line for health business. He has been a real leader in thinking about how the insurance industry and financial services more broadly can think about sustainability and be long-term. So, Thomas, thank you so much for joining me today.
Thank you, Sarah. Good to be with you.
So, insurance is sort of the ultimate short-term, long-term tension business, which is that you have long-tail risks, you have long-term customer relationships, but you tend to renew things in the short term. You have shareholders who worry about the short term. You have current events that hit you in the short term. So can you talk a little bit about how you balance the short-term pressures, which of course you must face every single day, with that long-term mindset of building a company that people rely on for years and years?
So it's absolutely true that we have this, coexistence of the short term and the long term, and also an insurance company is by definition a mirror of industry and society. And so managing all of this is never easy. Certainly not in a context that we see currently around the macro and financial environment that remains uncertain. If I don't want to sound too pessimistic. It's difficult to imagine at the moment where are the avenues of improvement in the short term when you think about it. And that's why I think one should also be able, and it's necessary to balance it against the long term, because this question around where do you want to go? What do you want to achieve? What societal goal, in our case, do you want to solve? Changes the perspective, liberates more energy for a longer term vision, and also then makes you more agile and reactive, because often we are caught in the short term. So what does it all mean to make it more concrete? When, for example, in 2016, we decided to acquire AXA XL, which was a US-based commercial insurer. We got a lot of criticism. The share price suffered a lot, and I was criticized to take too much risk, and it wasn't clear why we did it. For us, the aim was really to say, look, we need to go in these areas where there is the biggest amount of risk and the biggest growth on risk, which is in the corporate sector. When you look at it today, we were right, and the biggest amount of risks and new risk is exactly in that sector, in particular in this area of geopolitical tension.
Let's talk a little bit about geopolitical tension. So we'll maybe start in the U.S. and then we'll go more broadly. In the U.S., we've got a lot of tension in our politics. There's concern there's uncertainty. Our new president is issuing all sorts of executive orders, getting a lot of stuff done very quickly, has not been particularly concerned about climate and pushing back on some of that. But at the same time, we've had fires in Los Angeles, we've had hurricanes in unexpected places like the mountains of North Carolina. And so the insurance industry is a little bit in the spotlight. So how do you think about that tension between, and this must happen in many countries, sort of the current politics but what's really happening on the ground? How do you manage both of those?
I think first of all, it's important to have a clear view of what is happening because in your couple of phrases in introduction to the question, you mentioned plenty of risks. And so first of all, it's important to understand what risks do exist. We do that every year in a very, methodological way with our future risk report to really understand what really matters. And what is quite interesting to see is that the, let's say, top 10 risks haven't really changed over the last 10 years. But I mean, except maybe I would say for the year of COVID, where obviously the health risk was the number one, but all the other years you see a pretty consistent picture. But what has changed is a couple of other issues. Number one, those risks are interlinked today. So geopolitical and cyber risk is linked. Natural catastrophes and health and social risk is linked. And so this is what makes it more complicated and also more difficult to understand. And then you have a second phenomenon, which is that people are exposed to more risk, don't want to absorb more risk, and have less confidence in governments and states to resolve this. So it's an equation that is very difficult to solve. And so this makes it that we spend a lot of time in understanding these risks and also understanding the changes in these risks over the year, because it heavily also then has heavy implications around how we are designing our business approach.
And thinking about those risks and how they change obviously is core to your ability to underwrite and to manage your business. One of the things we're seeing a lot of discussion about is the differences between the U.S. and Europe, and the interest in more competitiveness in Europe, and an understanding or a feeling that Europe has been less competitive and need to streamline regulations, streamline to be more competitive. Do you see that affecting your business, or is that something that because you're so global, you sort of, it won't affect you because you're kind of beyond that? How do you feel about that?
No, look, we are affected by every change that happens anywhere because, as you say, we are very global. And to explain it simply, what an insurance is, you have your finger in every pie, but not too deep in. Which means basically both on the asset side and the underwriting side, diversification is the mantra of an insurer. And therefore, we are affected by all these issues, but, never so affected that it puts the company at risk. Coming back to Europe, I think you're absolutely right that the question of competitiveness is at the heart of the discussion. But competitiveness, I think, has several facets. I mean, it starts with the question of regulation. And when we think about regulation, I think we have to be careful that we find the right balance. I mean, today, the approaches are often that regulation needs to disappear completely. I think we need to be realistic on what the expectations are, because at the end of the day, it's not companies who make regulation, it's the governments and parliaments. And the way this is structured today, I would say we should probably more focus around the question of how can we make the current regulation easier and more digestible without shooting at the regulation itself. Secondly, I think when we think about competitiveness, it is also a question around have we in Europe succeeded in really exploiting the internal market? So I think what's very important now is the European Union has fully understood I think this issue around competitiveness. And now it's about how do you design as a commission, as the different countries, an action plan to also really deliver on it and make sure that you deliver quickly on it rather than taking too much time.
I think your point about streamlining compliance with the regulation rather than the regulation itself is a really that's a very important distinction, and I think that's extremely helpful. If we move a little bit more to climate,
Mm.
um, you have had a clear commitment to sustainability for a very long time. You were one of the first to divest from coal, and you spend a lot of time modeling climate and what's going to happen. And obviously, that's central to your risk, to your business because of the risk. But what we see in the financial markets is most financial professionals believe that climate risk is mispriced or not priced in markets. And obviously, you've got the underwriting side, you've also got the asset side. So, as an investor, how do you think about the pricing of risk in markets? And is there a way that investors can do that better than they're doing today?
So, I mean, look, first of all, this mispricing, I think, is clearly an issue at the moment. But I think there's also a miscomprehension of what is climate risk and how can it be solved. Because what you see today is that the frequency of perils has increased. So more claims are happening, which also then brings the necessity of rebalancing premium and claims, which often results in higher premiums because we can adapt mostly those prices once a year. It's also being done. However, you see on this mechanism a lot of government intervention that keeping this balance is not as possible as it used to be, which leads many of the participating parties to believe that it's mispriced or that it's becoming uninsurable. I am personally not of that opinion because if you have a problem, you need to see how you can solve it. And what you can, for example, see on natural catastrophes is that you can manage these claims better and bring this risk back in a zone where it's properly priced if you use more prevention. So if you look, for example, in the US at the Hurricane Katrina and Hurricane Irma, which had roughly the same trajectory, the cost has gone down over time and not up. Why? Because governments, companies, individuals have taken preventative measures to protect themselves better. And obviously, this is the area where we work a lot now, be it on the research and development side, be it on the investment in data, but also be it on launching new services. We have a company called AXA Climate that has about 200 environmental engineers only focusing on this and helping companies to prevent better. So if we continue to focus on prevention, if prevention becomes a mandatory part of an insurance solution, then climate can be properly priced again and will remain insured.
That's very interesting. And that sounds like something that sort of surpasses um the political wins one way or the other. Nobody wants to lose their house. Nobody wants to lose their business to a natural disaster. So is that being well received in terms of your environmental engineers figuring out solutions?
Look, the environmental engineers there have been convinced about this for a long time and are working on solutions. I think bringing the general public and politicians on this journey will take some time because obviously prevention means that the insured party, be it a government, be it a company or an individual, has to participate in their own destiny of how to manage the risk. And therefore, it's important that we continue this discussion and we also show real data and results that it really makes a difference, which we can. So today, for example, we work a lot with satellite imaging to really prove what prevention can do. And if you look recently into the dreadful fires around Los Angeles, those buildings that have been constructed with other materials than wood have mainly withstood the fires. So there is a way of really, helping with prevention. I think the conscience will come more and more because obviously the social pressures that are arising from these terrible catastrophes and also the amounts of money that governments have to mobilize to help in these difficult moments will bring this question more to the forefront. So I'm positive that it will come, but it probably needs a bit of time.
So on the insurance side, clearly you've thought a lot about this, how to mitigate things, how to prepare for whatever perils might come. On the market side or the investment side, um, what we see a lot of is because most investors have a fairly short-term time frame in terms of their performance benchmarks and so on. Maybe it's 1 year, maybe it's 3 years. That there are some people who are really trying to price either physical risks or future insurance costs or carbon pricing or something like that into their investments. But it sort of falls into two categories. There are either people who are very on this and very focused and sort of have a plan and are doing it, or at the other extreme, they're just saying it's too far away. I don't need to worry about that right now. The markets will take care of it. I'll worry about it later. What would you say to the sort of the second group, which is the investor who's saying, I don't need to think about this yet? Do you think that's right in that the market will adjust, over time and just like any other market, it will, incorporate these risks? Or are we going to have more one of those classic Minsky moments when people realize all of a sudden that they've got a lot of risk in their portfolios that they didn't recognize was there?
I think certainly neglecting this